on if you regulators for a moment. Although, as you were speaking, I kept thinking about the fact that in a crisis, you're really looking to internal leadership, the CEOs, the business heads, and how they all pull together to deal with urgent decision making and the right decisions really to support, what you from the Treasury perspective are recommending. But if we go back to regulators for a moment, how have regulatory requirements and oversight evolved, hopefully improved and strengthened over the years? And since we've talked about the different countries in which you've operated, would it be okay for you to talk about which countries you or regulators you most admire for, their forward thinking and quality of their procedures?
Yeah, maybe I tackle the first one, the last one first. My longest time in any of the postings has been in Singapore. And when you look at the Monetary Authority of Singapore and you look at the longevity of their planning, just how far forward they're looking, and you look at their way in which it's all integrated with government policy, and it's almost like the entire financial sector architecture in terms of growth, resourcing, regulations, it all comes together the most harmoniously, in my view, in Singapore. So that's where I would sort of say it's a kind of good balance between pragmatic and principled. And it's not separate. It's absolutely tied to the economic imperatives and ambitions of the country. So that's where I really would take my hat off. Now, when we talk about global regulations, and they tend to be, of course, I'm going to use this word rather loosely, but Western focused or Western originated. When you think about the Basel rules, for instance. And I think there have been some ups and downs. When we look at the Basel, which has been a 35-year journey, the Basel capital rules, for instance, what they've been trying to put is some guidelines which are globally applicable, and then you can obviously have some national discretions. But it started off very simply, right? Basel 1, very simple concepts in terms of minimum capital requirements, in terms of risk-weighted asset calculations, et cetera, et cetera, et cetera. And all good. And the objective was make the bank safer in terms of capital adequacy, while at the same time keeping it simple so that you get the consistency and standardization. But unfortunately, we then got to an area of Basel 2 where it sort of got into more flexible. Internal ratings-based assessments of RWA, other flexibilities, which meant that, yes, you might got more precision, but you got less consistency. And as we saw in the run-up to the global financial crisis, that less consistency resulted in explosive growth in some very dangerous areas, including off-balance sheet, including the size of the balance sheet just ballooned massively in that few years heading into the global financial crisis. So, in fact, when you got to Basel 3, to some extent, it was dealing with the problems of Basel 2, and Basel 4 continuing to deal with the problems of Basel 4, and in a way bring us all the way back to something which is a little bit more simple and a little bit less flexible while keeping the security side. So when you look at the global side, and coming a little bit more generally, I'm not separating the Fed, the Bank of England, the ECB. I'm putting that all into one place. I'm saying, well, the problem is that we've got more precision, but we've got a lot more complexity. And the complexity probably is way, way more than we need in terms of what we're trying to do. When we go back to the basis, we're trying to make sure capital, liquidity, interest rate risk on the big banking book, and within capital, you've got credit risk, market risk, operational risk, that they're properly controlled. Well, would you write thousands of pages of a rule book to do that if you're starting from scratch? Probably not. So, that's why in terms of my regulator scorecard, my balanced scorecard covers precision in capturing risk versus consistency, ease of application.
Right.
And I think if anything, we're much too far in terms of the complexity, and the Dow needs to come back. It needs to come back to something which is more standardized, more consistent, more understandable. I think that's where we're going. But that doesn't mean you can't have complexity. But complexity is then for internal risk departments. Internal risk job is to be as precise as is possible. And later when we discuss it, that's where technology comes in. It's not so much to make the standardized regulatory reports. It's to really understand and interpret and analyze risks in the best, most sophisticated fashion possible. So back to my scorecard. MES is my number one. I'm not going to separate the Fed, the Bank of England, and the ECB, because I think there's been over complexity has been the problem all the way down the line, and I'll link that also to Basel. And we've lost some of the beauty of the Basel One simplicity, which I think it's always going to be a balance, but I think we've gone too far, and it's going to take a while to row back from there.
Right. Thank you for that, Nick. Now, I'm actually going to switch tack a little bit. Again, going back to your profile on LinkedIn, I noticed that you had an assignment with the IMF for a while as an advisor. That was nearly a decade ago. But I'm curious, what was that experience like, and what kind of assignment did you work on?
Yeah, it's an interesting one. It was actually around 2016. You're right, 2015, 2016, and I was a financial sector consultant for the IMF. And the IMF at that time was very interested in looking at how the provision of financial services was changing post the global financial crisis and post the regulations that followed the global financial crisis. So they were interested in seeing, well, what is changing? What's happening to the financial sector after that? And so I was working on a report which they produce every 6 months called the Global Financial Stability Review, GFSR. Very good report. It's free to view, excellent report. And we were writing some pieces for that. Now, the key takeaways, and they're as relevant today, is that there's been a massive growth in the non-bank financial institutions. Massive, massive growth. And what am I talking about? Asset managers, pension funds, insurance, all of these areas. Now, to some extent, some of the risks which were more concentrated in the bank sector going into the global financial crisis have now got spread out more broadly across the broader financial sector, including those ones I just mentioned. And so, when we think about, well, where is the next big crisis likely to occur from? It may well not be in the banks. It could easily be in the non-bank financial sector. And we've already had experiences. So we had the UK pension funds, taking massive leverage positions on gilts, using some packaged products, almost went bankrupt, and actually resulted in a lot of monetary measures, and it in fact contributed to the exit of the UK Prime Minister at the time. So we have examples. We know the risks are there, and therefore I think if you're in the Treasury business, as this is what I do with my business now, I look beyond banks. I look into the other areas of the financial sector. I'm working now for the ASEAN Macroeconomic Research Office as a technical advisor. We do work for regulators in Cambodia, for instance. And I think there's a very good sort of crossover. If you've been working in Treasury, it does give you a good perspective for taking on some assignments with IMF, ADB, or AMRO, for instance. So this is the thing. It's a big switch across to the non-bank financial sector in terms of risks moving there. And maybe they're not so tightly controlled. That's certainly, they're not so tightly supervised. That is for sure.
So in the UK, Nick, who is the regulator for pension funds? Is it the same as for the banking industry?
It's rather fragmented. So at the time of that crisis, maybe it will change too. It was really on the peripheries. It was kind of separately supervised. Yes, there were some communication channels through, but clearly they didn't work very well in terms of the oversight. Otherwise, those levels of exposures would never have been allowed to happen. They weren't apparent on the balance sheets. You had to look together to see the on and off balance sheets to understand the full picture. And you had to also do sufficient stress tests to know, well, what would happen if we had a 300 basis point move in gilts? What would happen to our pension funds? Now, again, it comes back to some of the regulations. There might be a regulation that is, in a stress test, you do a 200 basis point shift or a 100 basis point. But what if that's not enough? The moves we've been seeing have been well over that. Silicon Valley faced a move way over that shift. US rates, mortgage rates, went from 3% to 8%. That's a 500 basis point move. So a 100 or 200 basis point stress test is not going to be enough to show you what could happen.
So, Nick, any thoughts on where you think the next potential global disaster might come from or originate from in terms of where? Is it war related, or what do you think it might be?
I think it's my front runner, a long way in front, by the way, is the cybersecurity, a long way in front. And I think as AI becomes more embedded, and in the early stages, it's like school fees, we call it. When you do something for the first time, there are always mistakes made, and some people call it school fees, paying the school fees. We haven't yet paid our AI school fees. So they're not going to be small. They are going to be massive school fees. So I really see, when you look at the number of incidents and the cost and the trend lines for the incidents and costs, and the way in which the digitalization of financial services has gone, that has to be the front runner. And in terms of where does it come in capital, for instance? So let's get back to our requirements for capital. Well, it probably comes in some kind of Pillar 2 in an ICAP when you're looking at assessing your risks. It's not directly in Pillar 1, right? Operational risk. Yes, there's been some sort of broadening and deepening of the operational risk weighted assets. But in terms of where the cyber risks are going, I would sort of say that at the moment, they're probably understated in terms of even the add-ons that are put into the ICAP. And I think that's an area we are going to see some very, very, very bad situations, because it can hit anywhere, anytime. And it unfortunately, it hits so many places at the same time, because here's the risk. And one thing I've learned about risk, Francis, over the years, they're not siloed. So you can have an operational risk, it then becomes a reputational risk, that spills over into liquidity risk, and that spills over into a capital risk.
Yeah.
All of these risks are interrelated, but the trigger, some of the fastest triggers, can come from cyber attack, disruption, ransomware, identity theft, stolen data, you name it, all kinds of different areas. It's only going to go in one direction, up, and it's exponentially up. So that would be my number one. In terms of geopolitical, in terms of markets, yes, of course we can have those risks, but to some extent we have got early warning indicators, at least on the market side, which are quite well developed. Geopolitical early warning indicators, in my view, are poorly developed, and the lessons from history are rarely learnt. Let me just give you an example which you are very familiar with, which is Myanmar.
Right.
So Myanmar, you have a history of military coup. I think we've had at least 2, maybe 3 now. And when you have a coup, it has a devastating effect on the financial market. Now, the only way, if you're a bank, the only way in which you can then position to be more resilient is you have to have the structure of the balance sheet not too exposed. And that means a fairly low loan to deposit ratio, probably around 50%. If it's around 80%, 90%, fine in the good days, but when the real severe extreme crisis hits, you can't change at that point in time. It's too late already. So the lesson for me is learn the lessons from your own national history, because history does repeat. And don't think too short term when you're running a bank's balance sheet, when you're a treasurer. You're going to be very unpopular. You're going to say, it will never happen here again. History repeats.
But that's an interesting topic, Nick. In terms of loan to deposit ratios as a potential security blanket, so to speak, how many of the large banks really would be operating at that kind of level? Because it has a fairly profound effect on profitability, right? And depending on the market they're in.
No, totally. And I'm not suggesting you should do it in a Singapore or but you will
In
go
markets
to,
that are vulnerable to this kind of risk, is what
yeah, when you're in a frontier market
Yeah.
with very little depth in terms of capital and money markets, you have to manage differently. You have to manage where your only tool is maybe deposits and maybe repoing securities. You have to operate in a different way, and that means a different structural balance sheet. Now, one thing I have observed, Francis, and it's because I'm doing a number of training courses every year, so I'm coming now into contact with bankers who've been in the business for maybe 10 to 15 years. And many of them have never experienced a crisis. And so when they think about treasury and their financial risk, they're thinking about fairly benign market conditions. And so when they're thinking about loan deposit ratios, do we need that anymore? It's not nearly as precise as LCR, NSFR, or these other measures, which there's some truth in that. And I'm not making a campaign for bring back the LDR or anything like that. I'm just saying it's one of the other measures. But in some of these markets, they are operating at 90 to 100% loan to deposit ratios. Now, I know, having seen a number of crises, that if you really hit a difficult situation in that whole market, in terms of a systemic market-wide shock, It's going to be tough. It could be very, very tough if that's the level of the LDR in that marketplace. And it's a difficult message to take away, particularly to a C-suite. They might think, oh yeah, we got to juice it up more. Let's get it, 95, da da da. I would kind of be cautioning. I would be saying, no, maybe it should be down to the 85 to 90 in that particular situation. But taking some of the edge off it.
Thank you for that, Nick.